In the previous pricing nugget, we learned that consumers become more price conscious during recessionary times because of three drivers. One reason why consumers become more price conscious is they become more anxious about their financial future. The question now is, how can you make your customers and consumers less anxious about their financial future? We will find out today. To help customers become less anxious about their financial future, let us borrow some inspiration from corporate cash flow management or liquidity management. Let us look at some terminology. First, we have cash flows that we get in, so money that we get, these incoming or positive cash flows. Then you have payments, you have outgoing or negative cash flows. And the difference between both are net or residual cash flows. And similar to corporate cash flow or liquidity management, you want to make sure that your net or residual cash flow is positive for each month. So we want to have our blue bar to be above the line, be positive. And that's not only for corporates. This holds also for consumers or customers. Let us look at these cash flows. Your customers get green bars as their incoming cash flow. They pay out the red bars, the negative cash flows, and the blue bar is the residual cash flow. A positive residual cash flow means in a given month they have a bit more money available than before. So they add to their emergency fund an available budget that helps them and insures them against this financial downturn. So this also means if the blue bar, the residual cash flow is negative, their emergency fund shrinks in this month and it leaves them more vulnerable to the economic crisis. So customers avoid having a negative residual cash flow in a given month. What happens now if the outgoing payments are not predictable? If the outgoing cash flows, the negative cash flows in a given month, fluctuate, this fluctuation also reflects in their residual cash flow. And this risk rings an alert bell with your customers. So they definitely prefer predictable negative cash flows over unpredictable ones, because this degree of uncertainty makes them more vulnerable to the financial crisis. What else can you do to help your customers avoid getting with their blue bar in the red? In this example, we have a large expense in month 1 and it exceeds the incoming, the positive cash flows, so that the residual cash flow becomes negative. What you could do is, you could take this huge negative cash flow and spread it out across multiple months so that the level of the negative cash flow matches or becomes less than the positive cash flow. So we match negative cash flows to positive ones, and therefore, that's a second principle, consumers prefer matching negative cash flows to positive ones, because if we match the timing and the magnitude and we can balance it out, it ensures that the residual cash flow does not become negative. What else can you do to help customers avoid that their residual cash flow becomes negative? You could lower prices. The complicated accounting terminology would be consumers prefer lower negative cash flows over higher negative ones. So lower prices are better than higher ones. What happens in terms of bars? With lower prices, the residual, the net cash flow increases by the magnitude that you decrease your prices. So we understand the principles now that we can apply. What does it mean for our pricing? The first principle tells us very much, make negative cash flows more predictable. And why are these cash flows not predictable? Customers know the price that they pay. But customers don't know whether the product delivers what they expect. Whether it's the right product or whether they need to buy another one, an alternative, so they need to buy a second product, or whether the product that they just bought breaks down a few weeks later and they have to buy a replacement product. You can take away these uncertainties and these unpredictable costs or negative cash flows in two ways. You can do it before the purchase. You can offer an extended trial or return period so that customers lose these uncertainties before making the final purchase. And you could offer an extended warranty period or any other guarantee that ensures customers don't have to buy a replacement product in the foreseeable future. So to make negative cash flows more predictable, you can offer extended trial or return periods or warranties or any other guarantee. The second principle tells us smooth negative cash flows. And how do you do it? For purchases, for example, that come with a one-time payment and that is particularly large, you could take this payment and spread it across multiple time periods, for example, month. So you offer more convenient financing or leasing options so that the payments for your product match the positive cash flows your customers generate, for example, salaries. Or second, and that's a bit trickier than it sounds here, you turn from a transaction-based business model to a subscription-based business model, and in this way you turn away from prices and payments for each single transaction to a flat fee for each time period that your customers use your product and services. And this flat fee is identical, predictable, and ideally matching the positive cash flows of your customers. The third principle tells us we should intelligently lower prices and more intelligently communicate price reductions. What can you do? Instead of lowering prices directly, you could give discounts in kind, such as buy 2, get 3. Your customers still save money and your company is a bit better off because first, you don't reduce your standard price level. So your customers still have your higher price level in mind and it still serves as an internal reference price. So you're not diluting your brand and lowering price expectations for your customers. And second, this kind of discount is actually a bit more profitable. Instead of cutting for this promotion, instead of cutting your prices by 33%. Second, when you communicate price reductions, have those customers in mind that are knowledgeable about economic topics and who understand that this economic downturn is only temporal. So if you have a high value offer and you promote it as available now, your customers understand that this is a time sensitive deal and this deal will disappear once the economy improves. And these customers see the value of this deal and are less likely to postpone their purchase but seize the opportunity and buy this product at this fantastic high value offer price. To make your customers less anxious about the financial future, we learned we should make negative cash flows more predictable, match negative cash flows to positive ones, and lower negative cash flows by intelligently lower prices. We also looked into how you could actually do it, and I guess these insights make your creative juices flow and you come up with many more ideas how you could do it. I hope I can leave you with some sparks of inspiration, and if you seek more inspiration on pricing and psychological pricing, join me at pricingnuggets.com. I see you there.